Let's get back onto that CPI number. Let's bring in Tom Simmons over at Jefferies, who focuses on fixed income. Tom, great to see you here this morning. What your take on the CPI report, and what do you think it means to the bond market?
Hey, good morning. Yeah, so the CPI report, I think, actually has a little bit more good news in it than it appears right on the surface. Obviously, as we see these eye-popping numbers like 8.5% year over year, comparisons with the late 1980s and, the early 1990s when inflation was really running quite hot. There's a number of things in here that suggest that we're starting to see inflation peak and it will roll over in the next few months. We saw these really big increases in gasoline prices. Important to keep in mind that CPI for March, the reference period here was right after the Russian invasion of Ukraine. So it really is capturing the most acute period of gasoline price increases. And we've seen them already starting to soften in the market a little bit in the few weeks since. The other thing is that services X energy, and if you strip out the airline component, that was actually a little bit softer as well than the last few months. Housing actually came in a little bit softer in the last few months as well. And goods X energy also are coming in a little bit softer as well. So, the consumer has been pretty well able to weather the storm here with inflation. Obviously it affects sentiment pretty negatively, and it's affected the markets, but we haven't really seen too much in terms of a deterioration in spending. And I expect that we'll continue to see the consumer be pretty resilient here in the next few months as well.
Tom, I posed this question to Brian Chung earlier, but do you want to get your take as well? Do you think this report and the breakdown by components, the increases or the decreases that we saw there, do you think that changes anything for the Fed?
I don't. I think that it gives them slightly better comfort in terms of the fact that, maybe they're not quite as far behind the curve on inflation as it originally appeared, but it doesn't change their imperative in terms of what they need to do in the next few months. They really do need to bring interest rates up quite a bit higher because it's clear that they got started way too late on the tightening cycle. The 50 basis point hikes that have been on the table here, I think they continue to be on the table. They're not going to look at this slight degree of deviation away from the recent trend as some indication that the transitory nature of inflation that narrative that they have been holding on to, they're not going to go back to that at this point. They know that in order to get inflation down, they need to bring rates above the neutral rate at some point. And in order to get there, that estimate, according to the Fed, is somewhere around 2.5 to 2.75%. They need to get there in a hurry. So we're still expecting that they're going to be raising rates 50 basis points at the May meeting, as well as 50 basis points at the June meeting. If anything, this maybe starts to take off the possibility that they could have done 75 basis points at one of their upcoming meetings, or perhaps that they would have had to have done an intermeeting hike. Those things seem to be off the table because at least it looks like the upside risks for inflation are starting to fade a little bit.
So, Tom, ahead of that May Fed meeting, do you see the 10-year breaking past 3%? And if it does, what does that mean to the stock market?
I think the 10-year has to go above 3% at some point. Brian mentioned earlier that it's this reflective of this idea that policy at some point is going to have to go above the neutral rate. It's the only way they're going to get inflation to start to go down, right? I mean, if they only bring policy up to the neutral rate, all that's supposed to do is allow the economy to continue to grow unimpeded, right? So in order to get things to slow down, in order to get inflation to go down, policy rates need to be above that 2.5 to 2.75% rate. And that means they're probably going to be the policy rate is probably going to be at least 3% at some point. So the market needs to reflect that. I think that the reason why it's been very slow to get there is that there is this sort of sense of pessimism based on previous experiences that the Fed either can't get up to the neutral rate, or when they do, they can't stay there for very long before the economy really starts to roll over. I think that there's a number of reasons for optimism that the Fed can engineer, if not a soft landing, at least a not so hard landing, just because of the strength of the labor market, the momentum in wages, consumer balance sheets are very, very strong. So I think the stock market, even though it will struggle somewhat with yields a little bit higher, should start to look at more of these consumer fundamentals as reasons for optimism that we won't see corporate profits deteriorate so fast, such that we should see a big sell-off. I think that the stock market will cool off a little bit, but I'm not particularly worried about some major event.
You mentioned consumer balance sheets. Do you expect that consumer spending is going to be able to continue being resilient, even if the rate of price increases slows from here? Because even if prices are rising at a slower rate, they are still going up.
They are still going up. We haven't seen it. We've seen a couple of reports from various credit card spending aggregators and the New York Fed's consumer sentiment or consumer expectations survey suggests that consumer budgets haven't really been drawn back here, even as prices have increased. Obviously, there is a limit to which consumers can continue to do that. With prices going up, endlessly. Obviously, at some point they would have to pull back. I still think that point is still pretty far from here. The consumer still has a lot of accumulated savings from during the pandemic era, whether that's the result of stimulus that was never spent or just accumulated wage increases that haven't been spent either. And we've seen that across the spectrum, all the way up from the high end of the skill level spectrum down to the low end. And so, I think that there's still plenty of reason for optimism that the wage pressures are going to continue to be, in a positive direction. Because there is still a relative shortage of labor in the labor market, and so with more and more spending power coming from wages, I do believe that they'll be able to at least sort of keep up with inflation from here. We are talking about prices going up, but again, I think that there are reasons to believe that the degree to which prices are going to continue to increase from here is not going to be what we saw for the last 12 to 18 months.
But Tom, back-to-back 50 basis point rate hikes from the Fed to cool the inflation like we're seeing in today's CPI, doesn't that choke off the economic recovery?
100 basis points from here is still a relatively low level for rates. We would be at 125, 150 basis points for policy rate. I think that the issues that would affect the economy negatively, we're already seeing even without the Fed hiking. Specifically mortgage interest rates are up pretty significantly. I think that's an area of concern. But the consumer, like I said, they're already basically funding a lot of their consumption with accumulated savings, and that costs them zero, right? They're not borrowing a lot in order to fund their consumption outside of homes and autos. So I do think that there's a risk. Obviously, the Fed wants to slow things down a little bit. They do want to take some of that demand out. Just that's the only way you're going to get inflation to come down. The Fed can affect the supply side in terms of creating more inventory of these goods that are in short supply. So the only thing they can really do is start to kind of cool demand a little bit. But again, I think that these big increases are really just reflective of the fact that they've been a little bit too easy to this point. And we're not talking about, successive 50 basis point hikes for months and months and months. It's really just this adjustment in the short term that is then going to set them on a trajectory for a smoother increase in rates into the future.
Tom Simmons, Jefferies fixed income money market economist. Good to see you.